The recovery in equity markets that started in March 2009 came to a halt in August 2011. As a result, risk aversion increased and equity markets sold off. The FTSE World for 2011 traded 5.6% lower in local currency, but 3.4% lower when you convert that into euros. The divergence between regions was quite remarkable during 2011. The US equity markets actually traded higher, while equity markets in Japan, Europe and emerging markets lost as much as 15% in local currencies. In Europe, the price differential between core and peripheral bonds continued to widen. The Eurozone sovereign crisis continued to intensify and spread to the larger economies, which had been a big concern. Now the yields on Spain and Italy have risen, and the spread of the Spanish and Italian yield over the German yield is now at levels where Ireland, Portugal and Greece asks the EU and the IMF for assistance and remove themselves from the market. However, the current bailout facilities does not have enough money in it to bail out Spain and Italy. In other advanced economies such as the UK, US and Japan, bond yields also fell to record low levels. Central banks in these economies have continued to adopt very accommodative monetary policies and are continuing to use alternative mechanisms such as quantitative easing. On the other hand, in emerging markets, central banks actually tightened monetary policy to 2011. However, as inflation has peaked in these regions in the summer of 2011, it is expected that monetary policy in emerging markets may actually tighten in 2012 as growth slows in these regions. Going into 2012, this Eurozone sovereign crisis remains the key risk for markets. The yields on Spanish and Italian debt are so high that it will be very expensive for them to refinance themselves. They have a lot of debt maturing, as does France have in the first quarter of this year, and it's unclear where the money will come from for this. This will create a lot of volatility for equity and bond markets. However, it is our central view that the Eurozone leaders and ECB will come to the assistance of these countries and that we will muddle through the crisis. As a result, you would expect that the yields on bonds between core and peripheral regions in the Eurozone will converge, with German yields rising slightly as risk aversion eases, while the yields on France, Spain and Italy should fall as the credit risk is removed from these markets. Aside from the Eurozone sovereign crisis, analysts are expected to continue to downgrade earnings forecasts, particularly in the first half of 2012. However, given the recent price moves, a lot of this is priced into markets. In Japan, Europe and in emerging markets, equity markets derated significantly during 2011. For example, market prices fell by close to 12 to 15%, while earnings continued to grow by 5 to 10%. As a result, valuations have fallen close to the levels which markets bottomed out in 2009. US, on the other hand, the derating has not been as significant. However, valuation levels are well below the average historical norms. Therefore, if investors have the appetite to cope with the volatility that will continue as a result of the Eurozone sovereign crisis, you are buying into equity markets at a much more reasonable level than you have done in recent history.